Every year, the U.S. Securities and Exchange Commission unveils its priorities, a highly anticipated roadmap that sets the tone for what Wall Street, investors, and financial professionals should expect in the coming months. These priorities are more than just a checklist. They're a signal to the entire financial industry about where the regulatory spotlight will shine brightest and which areas will face the most scrutiny. Firms across the country pore over this list, using it to shape their compliance strategies and prepare for upcoming examinations. It's a crucial tool that helps them anticipate regulatory moves, allocate resources, and ensure they're not caught off guard by new enforcement trends. For several years, one topic dominated the SEC's agenda: cryptocurrency. The agency's focus on digital assets and exchanges was relentless, with new rules, investigations, and enforcement actions making headlines almost every month. Crypto firms, investors, and even traditional financial institutions watched closely, knowing that the SEC's stance could make or break fortunes overnight. The agency's mission was clear: protect investors from fraud, market manipulation, and the unique risks posed by a rapidly evolving digital landscape. The SEC's warnings and actions sent a strong message: the crypto market would not be allowed to operate in the shadows. But in November 2025, when the SEC released its priorities for 2026, the financial world was stunned by a dramatic shift in focus. Headlines buzzed with speculation and surprise. The once prominent section dedicated to crypto had vanished. No mention, no special warnings, not even a footnote. It was as if the topic had been quietly erased from the regulatory agenda. Instead, the SEC's attention seemed to return to more traditional oversight areas. Think market integrity, investor protection, and systemic risk in established financial sectors. The omission sent shockwaves through both the crypto world and Wall Street. Crypto advocates wondered if this meant less scrutiny, or if a new regulatory approach was on the horizon, while traditional firms questioned what this pivot signaled for the broader market. The SEC's priorities list isn't just paperwork, it's a powerful statement of intent, reflecting the agency's evolving view of risk and its willingness to adapt to changing market realities. For compliance teams, it's a guidebook for the year ahead. For investors, it's a window into where regulators see the biggest threats and opportunities. And for the market as a whole, it's a signal that can shift strategies and reshape priorities overnight. The sudden de-emphasis on crypto signals a fundamental change in the SEC's perspective. Is this a sign that the agency believes the crypto market has matured, or is it simply shifting its focus to new and emerging risks? Whatever the reason, this move could reshape the regulatory landscape, redefine the government's relationship with the crypto industry, and set the stage for new dynamics between regulators and innovators. The question now is clear: what does this new direction mean for the future of finance, and how will the industry adapt to a world where yesterday's hot topic is no longer at the top of the SEC's agenda? The most striking change in the 2026 SEC priorities is the removal of crypto as a standalone focus. For years, the SEC's agenda was dominated by headlines about cryptocurrency enforcement, with dedicated teams and resources zeroing in on the sector. But now, in a move that's caught the attention of both Wall Street and Silicon Valley, crypto has been quietly folded into the background. Previously, crypto firms faced intense, targeted scrutiny. Now that spotlight is gone. The days of high-profile investigations and public warnings aimed specifically at crypto companies seem to be fading, replaced by a more generalized approach. Crypto is no longer singled out. Instead, it's folded into broader categories. The SEC now treats digital assets as just one part of the larger financial ecosystem, grouping them with other investment products and services. The SEC is refocusing on core principles: fiduciary duty, standards of conduct, and asset custody. These foundational issues are now at the heart of the agency's mission, signaling a return to basics and a renewed emphasis on investor protection across all sectors. Cybersecurity and the use of AI in finance are now front and center. With the rapid evolution of technology, the SEC is prioritizing the risks and opportunities posed by digital transformation, making sure that both traditional and emerging firms are prepared for new threats. This pivot suggests the SEC sees crypto as less urgent, or perhaps more integrated into the mainstream. Digital assets are no longer viewed as an outlier, but as a regular part of the financial landscape, subject to the same rules as everyone else. Some say it's a sign the industry has matured, others see political winds at play. The debate continues over whether this shift is a result of successful industry lobbying, changing public sentiment, or simply a recognition that crypto is here to stay. Either way, crypto firms may face a lighter regulatory touch, though oversight hasn't disappeared. The SEC is still watching, but the pressure has eased, giving companies more room to innovate and grow. The industry is no longer the SEC's primary target, a welcome change for many. As the regulatory landscape evolves, both investors and companies are watching closely to see what this new era will bring for crypto and the broader financial world. The SEC's Division of Examinations is the agency's boots on the ground. Its job inspect investment advisors, broker-dealers, and mutual funds to ensure compliance. Examiners review records, interview staff, and look for fraud or mismanagement. The annual priorities list tells these examiners where to focus. When crypto was a top concern, examiners zeroed in on digital asset risks. Now, without a crypto mandate, their approach is broader. Crypto firms are treated like any other. Examiners will still check for asset custody and risk disclosure, but within a general compliance framework. The message crypto is no longer a special case, but must meet the same standards as traditional finance. This shift signals a new era of regulatory parity. With the crypto frenzy fading from the headlines, the SEC is shifting its attention back to the bedrock of financial regulation. Instead of chasing the latest trends, the agency is doubling down on the core principles that have long defined its mission: protecting investors, maintaining fair markets, and ensuring transparency across the financial industry. The SEC's 2026 priorities put a spotlight on fiduciary duty, standards of conduct, asset custody, and data privacy. These aren't just buzzwords. They're the foundation of trust between financial professionals and their clients, and the SEC is making it clear that these areas will be under greater scrutiny than ever before. Fiduciary duty means advisors must always put their clients' interests ahead of their own. There are no exceptions or loopholes. Advisors are expected to act with honesty, integrity, and undivided loyalty, making decisions that benefit the client first and foremost. Examiners will take a closer look at investment recommendations and fee structures, searching for any conflicts of interest that could harm investors. This means firms must be more transparent about how they're compensated and why they recommend certain products. For broker-dealers, regulation best interest is more than a guideline. It's a mandate. Every recommendation must truly benefit the client, not just the broker's bottom line. The SEC will be watching to ensure that firms are living up to this higher standard. The SEC will also be checking compliance, especially when it comes to complex and emerging financial products. Firms must be able to demonstrate that they understand these products and are selling them appropriately to clients. Asset custody rules are designed to ensure that firms protect customer money and securities at all times. In an era of increasing cyber threats and sophisticated fraud, safeguarding client assets is more important than ever. Data privacy is also a top priority. New requirements are being introduced to make sure that client information is kept safe from breaches, leaks, and unauthorized access. Firms must invest in robust cybersecurity and data protection measures. The message is clear. As technology evolves and the financial landscape changes, the basics of investor protection remain paramount. The SEC is reminding firms that innovation should never come at the expense of client trust or safety. Ultimately, the SEC wants every firm to put security and transparency at the heart of their operations, ensuring that investors can participate in the markets with confidence and peace of mind. The SEC's shift can't be separated from the political climate in Washington. President Trump's administration has taken a pro-crypto stance, a sharp contrast to previous skepticism. Trump's rhetoric frames digital assets as innovation and financial freedom, criticizing regulatory overreach. This attitude has encouraged a friendlier regulatory approach and influenced SEC leadership. The Trump family's reported involvement in crypto ventures further signals support. Key appointments, like Chairman Paul Atkins, reflect this philosophy. The result: a regulatory environment more open to crypto, with priorities shifting away from strict oversight. The alignment between the White House and SEC is driving this new direction. For the crypto industry, it's a political tailwind that's hard to ignore. The crypto industry greeted the SEC's new priorities with relief and optimism. Years of regulatory uncertainty and scrutiny had stifled innovation and investment. The de-emphasis on crypto is seen as a green light for growth and development in the U.S. venture capitalists and entrepreneurs now see America as a more attractive place to build. The hope: this shift will reverse the trend of talent and capital fleeing overseas. Industry leaders are cautiously optimistic, knowing regulatory winds can change quickly. The SEC's new stance is viewed as a victory for industry lobbying and a sign that dialogue is replacing confrontation. The message of blockchain and digital assets are finally being taken seriously at the highest levels. Despite the celebration, the SEC quickly clarified its position. The priorities list isn't exhaustive. Crypto firms are still subject to oversight under broader categories. The agency reminded everyone: investor protection remains its core mission. Crypto activities will be examined through the lens of fiduciary duty, asset custody, and conduct standards. The difference? Crypto is no longer singled out, but bad actors will still face scrutiny. The SEC aims to balance innovation with accountability. The message: innovate, but don't neglect your responsibilities. The agency is stepping back, not stepping away. SEC Chairman Paul Atkins summed up the new approach. Examinations shouldn't be a gotcha exercise. The focus is shifting from confrontation to collaboration. The goal: help firms comply, not trap them in technicalities. The priorities list is meant to foster transparency and constructive dialogue. Examinations are now more like collaborative reviews than hostile interrogations. Firms are encouraged to work openly with examiners to identify and fix issues. Serious violations will still be addressed, but the agency is willing to help firms get it right. For investors, this means stronger, more resilient firms and fewer scandals. The SEC's mission remains investor protection, but the method is evolving. The SEC's new stance signals a new era for Wall Street and the crypto industry. A more hands-off approach gives innovators room to grow, with regulators as guides, not enforcers. The crypto sector now has a chance to prove it can self-police and build public trust. If it succeeds, digital assets could become a permanent part of global finance. If not, stricter oversight may return. For traditional firms, the focus on core duties and cybersecurity remains. The SEC aims to balance innovation with investor protection. The coming years will test whether this approach can foster a vibrant, safe financial market. The ultimate goal: a system that's innovative, fair, and worthy of public trust.